Have you ever wondered how the pros really build an investment portfolio? It's not about chasing hot stocks or getting lucky. It's actually about mastering a few core ideas: risk, leverage, and a really powerful strategy for putting them all together. So let's break down the foundation of smart investing, step by step. It really all comes down to this one question, doesn't it? How do you build the absolute smartest, most efficient portfolio you can? Forget all the guesswork and the noise. There is a systematic way to answer this, and that's exactly what we're about to unpack.
Okay, so our journey starts with the one fundamental choice that every single investor has to make. Seriously, everything else in finance is built right on top of this one core trade-off.
And here it is: risk versus reward. You just can't get something for nothing. It's the iron law of investing. If you want a shot at higher returns, you have to be willing to accept a higher level of risk. And on the flip side, if you want total safety, you have to be okay with lower potential growth. This is the trade-off. There's just no escaping it. So how does this big idea actually look in the real world? Well, it comes down to two basic building blocks, the ingredients that make up pretty much any portfolio. Let's take a look at your options. On one side, you've got your risk-free assets, like government bonds. Think of these as a nice, stable, paved walking path. The journey is super predictable. You know exactly where you're going to end up, but you're not going to get there very fast. Then on the other side, you have risky assets, like stocks. This is more like climbing a mountain. The potential reward, man, that view from the top, it's spectacular. But the path is uncertain, and there is a very real chance of falling. So why would anyone choose the dangerous mountain climb over the safe path? The answer is something called the risk premium. You can think of it like hazard pay for a tough job. It's the extra potential reward you expect to get as compensation for taking on all that extra risk. It is your paycheck for being brave enough to face the market's ups and downs. All right, now that we have our basic building blocks, let's add a tool that can completely change the game: leverage. You should think of this as a massive amplifier for everything we've just talked about. In the simplest terms, leverage is just using borrowed money, other people's money, to invest more than you actually have. It's like strapping a rocket booster to your investment. It gives you the power to control a much, much larger position with only a small amount of your own cash. But here is the crucial warning. That rocket fuel works in both directions. Leverage doesn't just make your wins bigger, it makes your losses bigger too, and just as powerfully. This is a tool that you have to treat with absolute respect. So here's how it works mechanically. It's pretty simple. You start with your own money, then you borrow more to add to the pile. But this simple process has a dramatic result. The final outcome, whether it's a big win or a big loss, is massively amplified compared to what you started with. And this chart, wow, it shows the stark reality of what we're talking about. A 10% market gain? That's great. But with 2 times leverage, it becomes a 20% return on your capital. That's the dream, right? But that dream can turn into a nightmare just as fast. The exact same 10% market drop now becomes a really painful 20% loss. Leverage cuts both ways with absolutely no mercy. So we have our assets and we have our amplifier. Now for the most important part of all. How do we combine them to build the single most efficient portfolio possible? Let's put this whole puzzle together. This quote really captures the whole modern approach to investing. The goal isn't to run away from risk. It's to be smart about it. It's about making sure that for whatever amount of risk you decide to take on, you're set up to get the absolute maximum possible reward for it. Now, the strategy for doing this has a pretty technical name: mean variance optimization. But don't worry about the jargon. Just think of it like a powerful recipe. It mathematically sifts through every possible mix of risky assets to find that one single blend that gives you the most return for the risk you're taking, the ultimate bang for your buck. And here's the most powerful and maybe the most surprising insight of all. This whole optimization process, it finds one single portfolio of risky assets that is mathematically the best for everybody. Let that sink in for a second. Your personal feelings about risk, whether you're aggressive or super conservative, that doesn't change the best recipe. It only changes how you use that recipe. A really aggressive investor will use leverage to amplify it, while a conservative one will blend it with safe risk-free assets to dial that risk way down. Okay, we've covered a lot of ground here, so let's distill all of that down into a strategic toolkit with just the key takeaways you really need to remember. So here's the whole strategy in a nutshell. First, you always acknowledge the risk-reward trade-off, and you demand that risk premium for any chances you take. Second, you figure out the single most efficient or optimal portfolio of risky assets. And then finally, you use your personal toolkit, either adding risk-free assets to water down the risk or using leverage to amplify it, to scale that optimal portfolio to exactly the level you're comfortable with. And this, right here, is the key mindset shift. Effective portfolio building isn't about the thrill of gambling on the next big thing. It's about designing a robust, logical system based on these fundamental principles of risk, reward, and optimization. So we end right back where we started, but now the question is really for you. Knowing this framework, the decision isn't what stock should I pick. The real question is, what is your price for uncertainty? How much risk are you personally willing to take for the reward you truly want?